In 2004, a study quietly published by researchers at the University of California, Davis, tracked the portfolios of 66,465 individual investors over 6 years. They found something that should have changed how most people invest, but largely didn't. The investors who traded the most, the ones who were most active, most engaged, most certain they were doing the right things, earned an average annual return of 11.4%. The investors who traded the least, the ones who barely touched their accounts, who made few decisions, who did almost nothing, earned 18.5%. The most active investors underperformed the least active ones by 7 percentage points per year. Over 10 years, that gap doesn't add up. It compounds, and compounded, a 7-point annual drag transforms what should have been a life-changing sum into something considerably more ordinary. The conclusion the data kept reaching, study after study, decade after decade, was not subtle. The investors winning over the long run weren't the ones doing more. They were the ones doing less. Specifically, carefully, deliberately less. This video is about what less actually looks like, why it works, and why, despite being demonstrably superior, most people find it almost psychologically impossible to maintain. Here is the investment strategy we're going to examine today in its entirety. Pick a low-cost index fund that tracks the total U.S. stock market, or the S&P 500. Buy it on a regular schedule, monthly, bi-weekly, whatever aligns with your income. Reinvest dividends automatically. Do not sell it when the market drops. Do not sell it when the news is catastrophic. Do not sell it when your neighbor tells you about something better. Hold it for decades. That's the whole thing. It sounds like a punchline. It sounds like advice for people who haven't learned enough to do something more sophisticated. And that reaction, the slight condescension, the quiet sense that surely there must be more to it, is the exact response that keeps most investors from benefiting from the most evidence-backed wealth-building strategy available to regular people. The strategy has a 40-year track record of outperforming the overwhelming majority of active alternatives. It has been validated by academic research, endorsed by Warren Buffett, demonstrated by Vanguard, Fidelity, and Schwab's own performance data, and explained in detail in books that have sold millions of copies. And still, the majority of individual investors don't use it as their primary strategy. Not because they haven't heard of it. Because it doesn't feel like enough. That feeling, the sense that you need to be doing more, choosing more, moving more, is the single most expensive instinct in personal investing. And it is what we need to understand before we look at the numbers. Let's do the math without shortcuts. $400 a month, invested in a low-cost total market index fund, using the historical average annual return of the U.S. stock market over the last 50 years, which is approximately 10.7% nominal, or roughly 7.5% after adjusting for inflation. We'll use 7.5%, because again, the inflation-adjusted number is the only one that corresponds to real purchasing power. Year 1, $4,800 invested. Balance, approximately $5,000. The market contributed about $200. Nothing to see here. Year 5, $24,000 invested. Balance, approximately $28,700. Market contribution so far, $4,700. Still feels modest. Year 10, $48,000 invested. Balance, approximately $69,400. Market contribution, $21,400. Something is beginning. Year 15, $72,000 invested. Balance, approximately $132,000. Market contribution, $60,000. The market has now contributed nearly as much as you have. Year 20, $96,000 invested. Balance, approximately $237,000. Market contribution, $141,000. You are now a minority shareholder in your own portfolio. The market is doing the heavier lifting. Year 25, 120,000 invested. Balance, approximately 410,000. Your personal contributions represent 29% of the final balance. The other 71% came from the machine running in the background while you lived your life. Year 30, $144,000 invested. Balance, approximately $695,000. Your money is nearly 5 times what you put in. But here's the part of the compounding curve almost no explanation of compound interest shows clearly enough. The final years do the most work. Of your $695,000 final balance, approximately $190,000 of it was added in just the last 3 years of the 30-year period. Nearly 28% of the entire 30-year outcome was created in the final 3 years. This has a critical practical implication. The investor who bails in year 27 because the market dropped 30% and the news was terrifying, and every instinct said sell doesn't just miss a few years of returns. They miss the phase of compounding where the machine runs fastest. They exit at the moment the strategy is about to deliver most of what it promised. The math of compound growth is not linear. The reward is backloaded. And that structure is what makes the psychological part, which we'll get to, genuinely difficult. Before we talk about why people struggle with this strategy, it's worth being precise about what an index fund actually is. Because most explanations skip this, and the skip matters. An index fund is not a bet on the stock market going up. It is not a bet on any particular company performing well. It is a bet on one thing: that the American economy, composed of its publicly traded companies, will be worth more in aggregate 30 years from now than it is today. That is a different claim than stocks go up. It is a structural claim about economic growth over time. When you buy a total market index fund, you own a small piece of every publicly traded company in the United States, weighted by their market value. When one company fails, your exposure to it was proportional to its size, and it's automatically replaced in the index by the companies that succeed. The index is self-cleaning. It continuously rotates out the losers and retains the winners, without requiring you to identify which is which. This is the structural advantage that active stock picking cannot replicate at scale. An active investor has to be right about which companies will be the winners. An index fund investor doesn't need to know. The index finds them by definition. Because the index owns everything, it automatically holds the winners in proportion to how much they win. Hendrik Bessembinder at Arizona State University published research tracking 26,168 individual U.S. stocks from 1926 to 2019. He found that just 86 companies, 0.3% of the total, generated half of all stock market wealth over that entire period. Half of all wealth. From 0.3% of stocks. The active investor's challenge is identifying those 86 in advance, from a pool of 26,000, before they become the winners, not after. The index fund investor doesn't have to. They own all 26,000. They automatically capture the 86. That is not average performance. That is the only reliable way to guarantee you hold the companies that matter before you know which ones they are. Here is the number that should settle the but professionals can beat this objection permanently. Every year, Standard & Poor's publishes what's called the SPIVA scorecard, a comprehensive analysis of how actively managed funds perform against their benchmark index. The 2023 report covered 15 years of data. Over 15 years, 92.2% of large-cap active fund managers underperformed the S&P 500 index. Not 52%, not 60%, 92%. These are not amateur investors. These are portfolio managers with MBAs from elite universities, analyst teams, Bloomberg terminals, proprietary research, decades of experience, and every informational advantage available in modern finance. And 9 out of 10 of them, over a 15-year period, produced a worse outcome than a fund that simply held the market. Now here's the more uncomfortable finding within that data. Of the 8% who outperformed over any given 15-year period, the majority did not repeat that outperformance in the following period. The SPIVA Persistence Scorecard, which tracks whether top quartile managers stay in the top quartile, consistently finds that approximately 97% of top quartile funds do not remain in the top quartile over subsequent 5-year periods, which means identifying a manager who will beat the market in advance is approximately as reliable as identifying a coin flip that will come up heads 10 times in a row. Some coins do it. You cannot predict which ones. And the cost of paying a manager to try through fees, through trading costs, through tax drag, comes directly out of your returns, whether they win or not. The fee differential matters here specifically. The average actively managed fund charges approximately 0.6 to 1% in annual fees. The average index fund charges 0.03% to 0.1%. That gap, compounded over 30 years on a $400 monthly investment, costs you approximately $80,000 to $120,000 in final wealth. You pay more for a service that statistically underperforms over periods that matter. That is the arithmetic case for indexing, stripped to its structure. The math of index fund investing is simple. The execution is not. Here's what actually happens. The market drops 38% in 2008. Not on paper on your statement. The number you've been watching grow for 10 years loses more than a third of its value in 12 months. The news says the financial system may not recover. Credible economists are using the word depression. The right move, mathematically, is to do nothing. The psychological experience of doing nothing while your net worth falls by a third is not well described by the phrase mathematically optimal. The market drops 34% in 33 days in March 2020, the fastest crash in U.S. market history. The right move is to hold, or better, to buy more. What most investors did was sell, locking in losses right before the fastest recovery in U.S. market history followed immediately after. Vanguard analyzed the behavior of its own investors through this period. The investors who made no changes to their portfolios between February and June 2020 finished the year up approximately 30%. The investors who moved to cash or bonds during the crash and returned to equities after the recovery earned significantly less even if they timed the re-entry reasonably well. The behavioral gap, the difference between the return an investment earns and the return the investor in that investment earns, is the most reliably documented phenomenon in retail investing. Dalbar, a financial services research firm, has tracked this gap annually for over 30 years. Their consistent finding? The average equity mutual fund investor has earned approximately 3.5 to 4.5 percentage points less per year than the funds they invested in, due entirely to the timing of their entry and exit decisions. 3 to 4 points per year, compounded over 20 years, that gap reduces a final portfolio by approximately 40%. Not from bad fund selection, from moving in and out. The strategy is passive. Executing it is not. The enemy of the boring portfolio is not the market. It is the investor's own response to the market. And every crash, every inevitable, mathematically certain 20-30% drawdown that the historical record guarantees will occur multiple times in any 30-year investing period, is a test of whether the investor can maintain the position that the math requires. There is one dimension of index fund investing that most beginner-level explanations skip, and it is responsible for a meaningful percentage of the final outcome, not the fund you choose, where you hold it. The U.S. tax code provides three primary account structures that allow investments to compound without tax drag eating into the growth annually. Understanding which one to use and when is not complexity for its own sake is the difference of hundreds of thousands of dollars over a 30-year period. The first is a traditional IRA, or 401k. You contribute pre-tax dollars, meaning the money goes in before income tax is assessed, reducing your taxable income today. The investment grows tax-deferred. You pay income tax when you withdraw in retirement. The second is a Roth IRA, or Roth 401k. You contribute after tax dollars, no upfront tax benefit. But the investment grows completely tax-free. Withdrawals in retirement are tax-free. For someone who expects to be in a higher tax bracket in retirement than today, or who simply wants certainty about future tax treatment, this is often the more powerful structure. The third is a taxable brokerage account, no contribution limits, no restrictions, full flexibility. But every dividend and every realized gain is a taxable event. The drag is real and compounds in the wrong direction. The hierarchy for most people, under most circumstances, max your 401k to at least the employer match first that match is an immediate, guaranteed 50-100% return on the match portion, and no index fund competes with that. Then contribute to a Roth IRA up to the annual limit. Then use a taxable account for anything above those thresholds. The fund inside all three can be identical. A low-cost total market index fund works in any of them. The account is the tax structure. The fund is the engine. You need both to run properly. Let's come back to where we started. Two investors. One active, one passive. After 6 years, the passive investor outperformed the active, won by 7 percentage points annually. After 30 years, that 7-point gap doesn't just widen it, restructures the entire outcome. The passive investor arrives at retirement with roughly 3 times the wealth of their active counterpart, having spent a fraction of the time, attention, and anxiety. That is not an outlier finding. That is the consistent, replicable, peer-reviewed, 4-decade finding of the academic literature on retail investing. The boring portfolio is not boring because it requires ignorance. It is boring by design. The entire architecture of the strategy is built to remove the investor's ability to make the mistakes that the data consistently shows investors make when given the opportunity to make them. The question that is worth sitting with is not whether the math works. The math is settled. The question is whether you can tolerate being boring for 30 years in a financial culture that rewards the appearance of activity, celebrates stock picks, amplifies market panic, and makes doing nothing feel like doing something wrong. Most people cannot. And the data shows it. The behavior gap, the consistent, documented underperformance of actual investors relative to the funds they invest in, is the price of not being boring. The investors who close that gap are not smarter. They are not better at predicting markets. They have simply made peace with the one thing the strategy actually requires: staying in the machine long enough for the machine to work. One fund, one schedule. One decision made once, then honored daily by not making another one. 40 years of that is $695,000 that otherwise wasn't there. That is not nothing. That is the whole point. If this clarified something about why the simplest strategy is often the strongest one, that's the goal. The one question I want you to take away from this: if your current investment approach requires more than one decision per year, what is that complexity costing you? Drop your answer in the comments. I read them all. Subscribe if you want more of this, the evidence-based version, without the noise. See you in the next one.